Welcome back to the Exchange on Arise. It's the largest hold button pushed on a drilling project in the oil industry. Amid plunging oil prices over the last 6 months worldwide, Chevron has announced that it's suspending its plan to drill in the Arctic indefinitely. With more on the impact of falling oil prices, Darren Schurringa, Chief Investment Officer at Yorkville Capital Management, joins us on the set here. Thank you for coming to the Exchange.
Gary, it's a pleasure to be here.
So is this project that Chevron, is that the tip of the spear in terms of what to expect from the oil industry in terms of new projects and R&D and all of that down the road?
Absolutely. What we're seeing overall is CapEx budgets will be cut next year. And they've already been announced. And the most expensive regions are the first ones to get cut. So drilling in the Arctic, you're not drilling all year long. You're actually drilling in the winter. When it's frozen, it turns into mush in the summer that you can't drive through. So very expensive to extract oil, very expensive to drill for oil in the Arctic. Therefore, companies cut these marginal projects first. And we've seen that also offshore.
Mm-hmm. Now, usually at this time, whether it's oil or gold or anything else in this form, is this the time to buy? Or are people sort of now trying to, who have that kind of money, are they thinking about trying to round up as much energy stock as they can?
Well, it's interesting. I think that it's very difficult to predict the price of oil. And for most investors, I'd sit on the sideline. If it's contingent upon the price of any commodity, very difficult to do. So where I think there's a great opportunity is in the area that we focus on, which is master limited partnership. It's a way of playing the U.S. energy revolution without having to get the price of oil or natural gas correct. So distributions or cash flow are not contingent upon oil prices. So it gives investors a chance to play the shale boom in the United States, but from a safe, hard asset perspective.
Now, we've seen this play done before when the United States was pushing renewable energy sources from corn and sugarcane. That crushed the industry when those prices dropped. Do you think that the shale industry has enough resources long term to be able to ride out this storm, or could that put the light out on it for a while?
That's a very good question. So shale, the United States isn't the most expensive producer globally. So I've already mentioned a couple offshore, more expensive, south of us in Brazil, a bonanza find down there, extremely expensive, over $100 a barrel. I'm really excited long-term about the prospects in the United States for one reason. Right now, in unconventional shale plays, we're only withdrawing about 10% of the resource. We're leaving 90% in the ground. When you look at vertical drilling, we're pulling out 90% of the resources. To go from 10% to 90%, we're driving down the cost of oil. So again, to go from 10 to 20%, if it's $60 a barrel, that 60 just got cut in half to $30 a barrel. You go to 40% recovery rates, it's now $15 a barrel. Now we're competing with Saudi Arabia in terms of the lowest cost producer of oil globally. Now, again, I don't think oil prices will be set by the incremental most expensive producer on a global basis. The United States isn't going to start producing 10, 20, 30 million more barrels of oil per day. But incrementally, long term, the United States is probably one of the best plays in oil on a global basis.
At what stage at what price do you think that this becomes unsustainable for the Saudis or OPEC in general? At what point will the other members sort of rattle and come with the torches, basically saying you've got to decrease production?
Well, two things will happen, and it's already happening in the United States. Chevron's a good example of that. The budget's coming down. The E&P budgets of next year, exploration and production budgets, your drilling budgets coming down in the United States anywhere between 30 and north of 50% we've seen in some cases. The reduction in spending next year on drilling will bring production down. The United States, if it reduces around 30%, the money we're going to put in next year will bring down production. That will cause oil prices to start coming up. But I see that not as a fact, won't really roll into mid of next year, so mid of 2015.
Well, something we'll be watching certainly for the next couple of weeks, maybe months, right?
Yes.
Darren Schurringa from Yorkville Capital, thanks for joining us.
Thanks, Gary.